Hi and welcome back to the channel. The market has been an absolute bloodbath recently, with the worst start to the year since the dot-com crash in the year 2000. There's been lots of panic with many people's portfolios in the red, and many growth stocks are down 50% or more from their all-time highs. In the past week, one high-profile YouTuber called MeetKevin released a video stating that he sold all of his stocks. So in this video, I'm going to share my personal opinion on this and whether it's time to sell. Now, before we get any further, if you have lost any money in the stock market recently, or if you get any value from this video, then please smash the like button, as it really helps the channel massively. So both the S&P 500 and the Nasdaq are into correction territory. A market correction is between 10 and 19% and happens on average every 16 months. The average correction involves a decline of about 15.6% and on average lasts about 71.6 days. The Russell 2000, which encompasses small cap companies, is now in a bear market, which is more than a 20% decline from the peak, and there is the possibility the Nasdaq isn't far behind. Bear markets happen on average every 7 to 10 years, with an average drop of 33% over a period of 363 days. And any drops over 39% is considered a crash, which has only happened 4 times in the past 120 years. So these events are not that common. So what's been causing the recent downturn in the market? Well, there's many things. Inflation is riding high. Interest rates are being hiked in the US in March, which has just been announced tonight. There is potentially going to be more interest rate hikes than originally expected. The Fed is still tapering. Key earnings are affecting the market also, plus supply chain issues are still a problem. And now there is a fear of a war erupting between Russia and Ukraine as Russian troops build up on the border of Ukraine. So what is MeetKevin's plan? Basically, he sold all of his stocks and he's going to try and time the market and buy back in at a lower price, therefore profiting the difference, because in his eyes he potentially sees the market going down further until fear and uncertainty goes away, and he's expecting this to continue for the next few months. Now, if you sell out, then you may look clever while the market keeps going down, but at what point do you buy back in? Now that's the tough point, and technically you'd have to time it right twice. And this is the complete opposite advice of what every highly respected investor tells you to do. Now, MeetKevin isn't an idiot if you've ever watched any of his videos, and you'll see he's highly educated and very well informed. But I personally think this is a very silly move. MeetKevin may pull this off if he's lucky, but the odds are stacked against him. Selling as the market dips and buying back in at a lower price is in principle a great way to make money, but the odds of you actually buying in at a lower price successfully and then doing this repeatedly over time is massively stacked against you. It's a huge gamble and is like trying to catch a falling knife. Now, the worst thing you could do in the market right now is to panic and sell. Now, props to the traveling trader on YouTube for finding these links. I'll put a link to his video down in the comments below, but he found a link on Hartford Funds stating the following. So bear markets are normal, and there have been 26 bear markets in the S&P 500 index since 1928. And there have also been 27 bull markets, and stocks have risen massively over this time. Bear markets also tend to be short-lived, with the average bear market being about 9.5 months and the average bull market lasting 2.7 years. I'll also put the link to this Hartford Funds site in the description below also. The main point from this site is number 7, that half of the S&P 500's index's strongest days in the last 20 years occurred during a bear market, and another 34% of the market's best days took place in the first 2 months of a bull market, before it was clear a bull market had begun. So in other words, the best way to weather a downturn could be to stay invested, since it's difficult to time the market recovery. Also, here's another infographic stating why you should stay invested in a bear market. And this is showing that if you miss the 10 best days in the market every decade since 1930, your return from the S&P 500 would be only 28%. That's 28% over like 91 to 92 years, which is ridiculous. But If you had stayed invested, then your returns would be 17,715%. Now, bear in mind that this article was made in 2021. Even in 2020 alone, you would have made 18%, compared to minus 33% if you had missed the best 10 days. If you went back to 2010, then for that decade, your returns would be 190%. And if you missed the 10 best days, your returns would be halved to 95%. If that wasn't bad enough, then say you do sell out with the aim of buying back in 90% of countries around the world, you will likely have to pay capital gains tax. And this can be anything from 20 to 50% depending where you are and how long you've held the stocks. So investing consistently is the best strategy here, and you will increase your returns over the long term. Graham Stefan posted a video the other day that referred to an Instagram page called Personal Finance Club. So I'll put a link to both his video and Personal Finance Club's Instagram in the description below. And basically on that Instagram page, this guy made a post which, if it's true, and I'm hoping it's true considering the number of his followers, it really highlights how staying in the market is the best option. He analysed the last 41 years of being invested in the S&P 500 and simulated 3 different scenarios. The first scenario is with Tiffany, who had the worst timing and invested $200 a month in a high interest savings account, only to dump it into the market the day before the 4 biggest market crashes. And she never sold. So without her selling, her buy and hold strategy turned $99,000 into $773,357. Then the next scenario is with Brittany, who managed to have the best timing in the world. And she saved her money, then invested it the day the market was the lowest after each of these 5 downturns in the market, which is realistically impossible to time exactly, but either way, her perfect timing earned her $1,123,573. Then the third scenario is with Sarah, who didn't watch the markets. She opened an account in 1979, putting $200 a month in an index fund and never looked at her account. Today, her account is worth $1,620,707, which shows that timing the market is actually really inefficient, and your best bet is to invest consistently. It's all about time in the market rather than timing the market. So seeing your portfolio drop huge amounts in a day is horrible, but it's part and parcel of investing. And while nothing I've talked about in this video is financial advice, because at the end of the day, I am just a YouTuber, just don't panic. I know it's horrible to think about how much money your portfolio is down, but technically you've not realized those losses until you close a trade. And if it really bothers you that much, then sometimes the best thing is to just kick back and not look at your portfolio. And that's what I'm going to do. I'm going to kick back and have myself a beer, because it will all blow over in the end. And I'll be sitting on the sidelines with some cash, waiting to buy more of the quality stocks I've been buying over the past year, but at discount prices. So I hope you've enjoyed this video. If you got any value from it, then please smash the like button, as it helps the channel massively. Let us know what you're doing right now. Have you sold out, or are you staying invested? And let us know what stocks you're planning to buy at discount prices. Also, for those of you who haven't subscribed already and want to learn more about personal finance, investing, or how to reach financial freedom, then I recommend you subscribe and press the bell icon, as I upload new videos every week. It's been Ollie from Get Geek Finance. Much love as always. Thanks for watching, and I'll catch you in the next one.